Hi, Else here, and in this video we'll be exploring financial statements, what they look like, and how they interconnect. Why are financial statements necessary? Financial statements tell a business's story, what it does, and how well it does it. They provide a business's financial performance, its current financial position, and its cash flows. Both internal and external stakeholders use the financial statements to analyze a business and answer questions. That allows them to make decisions and meet their objectives. A business will produce the following financial statements: income statement, statement of retained earnings, balance sheet, and the statement of cash flows. Statements must be completed in a specific order, and we'll start with the income statement. An income statement reports the results of a business's day-to-day operations, the revenues, less the expenses incurred to generate that revenue, to obtain a total profit. The income statement measures a business's performance within a period of time, either annually, quarterly, or monthly. To better understand the income statement, we have to understand the two main elements, revenues and expenses. Revenues are the income a business earns. There are only two ways to earn revenue. Businesses either provide a service or a good. The key to revenue is that it must be earned. What does that mean? It means that the business has done their job, past tense. For example, if a lawn care business plans to mow a customer's lawn tomorrow, that is not earned revenue today because they have not done their job yet. After they've finished mowing the customer's lawn, they have earned their revenue. If a retail store plans to sell a product to a customer tomorrow, revenue is not earned because, again, the business has not as yet done their job. Revenues can only be recognized when the business has finished their job, provided the service, or delivered the good. Notice the past tense. That's very important with regards to the element revenue. To summarize, revenue is income earned through the day-to-day activities of a business when a service or a good is provided. Revenue, earned by providing services or goods. Expenses are the cost of the resources that have been used, consumed, or incurred to help generate revenue. Expenses are best described through an example. If you use gas in a lawnmower when you mow a customer's lawn, then the gas that was consumed during the mowing of the lawn would be an expense, a cost of earning the revenue. Why? Because the gas was consumed in order to help generate service revenue. Note that the concept of used, consumed, or incurred is important, but so is the fact that these things must have happened to help earn revenue. Costs or expenses must be matched to the revenue they help to generate. Expenses, costs that have been used, consumed, or incurred to help generate revenue. Now that you understand the elements that make up the income statement, let's look at the format. The format of an income statement is important. Note that the heading must always include the business name, the title of the financial statement, and the time period covered. Then revenues are listed first. If there are multiple revenues, you must list each different type of revenue individually, and then show a subtotal called total revenues. Is there a correct order for revenues? Generally, they are always placed in order of magnitude. That means from the highest amount to the lowest amount. Why? Remember the purpose of financial reporting, to provide information for external stakeholders to make resource allocation decisions. Therefore, highlighting the largest sources of revenue first helps to make the information more understandable and to increase clarity. Expenses are listed next with a heading called Operating Expenses. The order of expenses, similar to revenues, is always from largest to smallest. After listing all the expenses, the statement provides a total for all the expenses, excluding income tax expense. Next is the subtotal Profit Before Income Tax Expense, calculated as total revenues minus total operating expenses. Then income tax expense as a separate line item before listing the final profit amount. Often students place income tax expense in the same listing as operating expenses. However, this is incorrect. Operating expenses are the costs of running a business and are controllable, for the most part, by the business. Income tax expense is prescribed by the CRA, the Canada Revenue Agency, and is not controllable by the business. As a consequence, income tax expense must be listed separately. What happens if expenses are greater than revenues? Then a net loss amount is provided at the bottom of the income statement. The statement we have just developed is called the single-step income statement. We'll be covering a multiple-step income statement in a future video. Remember to pause the video to determine your answer to this check your understanding question about the uses of the income statement. Bankers are interested in a business's past performance because it helps them The answer is not A. Determining the amount of debt a business currently has is answered by reviewing the balance sheet. The answer is not B, as the current value of a business's property, plant, and equipment is not available on any financial statement that is produced. The answer is definitely not D either. Determining if a business is profitable enough to pay dividends is what owners will use the income statement for, not bankers. The correct answer is C, as banks are interested in determining the future profitability of the business. Why is this? Because it will help banks predict if the business will repay the loan plus interest in the future. Owners use the income statement to determine if the business is profitable and if they will be paid dividends in the future. Banks, also called lenders, use the income statement to help them determine if they will fund a business with loans and if the business will, in the future, repay the loan plus interest. Other creditors use this statement to figure out if the business will be profitable enough to repay their debts as they come due. The long-term survival of any business depends on its ability to produce revenues that are greater than their expenses. The income statement, which shows past performance, is used by both internal and external stakeholders to predict how profitable the business will be in the future. The income statement is a statement that is connected to one other financial statement. The profit or net loss from the income statement is used in the statement of retained earnings. Since the profit from the income statement is used in another statement, it is always the first financial statement to be completed. The next statement produced is the statement of retained earnings. We'll be covering that statement in our next video.